We had quite the sell-off on Wall Street today. S&P 500 was down over 1%. NASDAQ Composite was down over 2%. So I'm going to go through my typical routine and try to judge what the best index is versus what the worst index is right now and show you some distinguishing elements between the charts. I also want to point out a factor that really took it across the chin here today. It had been a factor that has been out of favor for a while. Looked like it was snapping back earlier this week, but wham, we're right back down near the lows of that particular factor. Also wanted to show you an emerging relative strength trend that we're starting to recognize with foreign stocks versus United States stocks. And then last but not least, I also want to take a look at a new trade application example where I will show you an under-the-radar dividend growth investment that many of you probably aren't familiar with in order to sell a put upon it at a more attractive price, even though right now it already has an oversold cluster signal on its weekly candle chart, in addition to being attractively valued within the dividend stair-step chart. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 13th, 2022. First of all, if you're new, remember to go over to YouTube, click subscribe on our channel, then go down below into our description area where you can sign up for our email distribution list. Remember, on those emails, not only are we notifying you of when we're posting these videos, but we're also giving you a heads up as to what stocks are giving you overbought and oversold cluster signals within the S&P 500. In fact, today, one of my favorite REITs, one of my favorite financials, and one of my favorite consumer discretionary stocks is showing up on the oversold list. So be on the lookout for that email there. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. I would encourage you to follow me if you're not doing so already. And we really appreciate those of you that click like and retweet on these Market Outlook related tweets. Last but not least, we do have a presence over on Facebook. Feel free to join our group at the web address you see listed in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, as we bring up our heat map for the S&P 500 today, it was an ugly session out there. The S&P 500 down over 1%. No surprise that a lot of our mega cap tech participants here really suffered. Microsoft, as just one example, was down 4% today. That's a pretty ugly day for that behemoth, right? It's a lot more often you'll see like Nvidia and Tesla and some of those more kind of up-and-coming growth companies down 4%. But Microsoft, that doesn't happen all that often. So that was notable drop there for Microsoft today. Apple was down almost 2% today, so also took it across the chin. Amazon was down about 2.5%. Alphabet was down almost 2%. And then when we get into some of those, more growth-oriented companies like Nvidia, it was down 5% today. ServiceNow was down 9% today. Adobe was down 3%. Salesforce down almost 4%. And then good old Tesla was down almost 7% today. Note the difference between Tesla and Ford. Tesla down 7%. Ford actually up 2% to 20-year highs today. GM wasn't that far behind it. It actually closed higher by over 1%. So remember, that was a role reversal for what we've seen in recent years where Tesla has been going up day after day after day without looking back, and Ford and GM are kind of afterthoughts in the automotive market. Seems like that role has changed here more recently. As we kind of look over on the right-hand side of this heat map, you do see a lot more green over there. So today's meltdown, I guess if you could call it that in the market, was largely attributed to the technology-oriented areas. But your more traditional areas within the market like industrials and consumer staples and financials and utilities and the like, you do have plenty of green in there. So this was not one of those overwhelming down days where you saw like 90% of the participants finish in the red, right? We've seen those types of days before. That was not what we had today. Today was a day where the generals went out and got shot. Some of the soldiers within the army, they're still alive. So it was an interesting day to say the least. But you can see here in the middle, we had some major players that did finish in the green, including Walmart was up over 1%. Coca-Cola was up there near its all-time highs. Pepsi was up just fractionally. Tobacco companies like Philip Morris and Altria both up here today as well. You know, we saw a lot of the utility stocks close in the green today. However, utilities are such small from a market cap perspective that they don't really have a lot of impact on the market. But industrials were a little bit of a surprise. Industrials did close higher today as well. There were only 3 sectors that finished higher. We'll talk about that a little bit later. But industrials is actually one of them. Remember, industrials are a little bit more cyclical, so it's not entirely surprising that consumer staples and utilities finished higher today. But it's a little bit more surprising that on a big down day, industrials managed to close in the green. You can see all of that green there from stocks like Boeing and Raytheon and Lockheed Martin and Caterpillar and Honeywell and Union Pacific, et cetera, et cetera. So you can see that, you know, the industrials did manage to hang in there just a little bit better here today. Also, I wanted to point out again, I mentioned this last week. I can't remember if it was in this presentation or if it was in one of my premium classes, but we discussed this to a degree in my Q&A class again here earlier today, and I wanted to point it out to you guys here in the YouTube video as well. Communications still is performing very poorly at a high level, but communications is driven by just a handful of the mega cap players like Alphabet and like Meta or Google and Facebook, however you want to say that. You could also throw Disney and Netflix in there, but those are your big players. That's what really controls the market activity of something like XLC. But one thing I have noticed here in recent weeks is there has been some resilience underneath the hood in some of those old school communications companies. AT&T, Verizon, Comcast, Charter, Omnicom, got to be careful there, not the variant of COVID, but this is Omnicom, the advertising behemoth. And then also stocks like Viacom, I'm not sure if that's in there. There it is. Viacom was up 3.5% today. So, you know, who knows how long that lasts, but that is something that is not just a one-day phenomenon. That is something I have been noticing so far in 2022, that although XLC is down significantly, and it appears from a high level that communications in general is doing poorly, just like it had at the end of 2021. If you were to look underneath the hood, there's actually some stability forming in the old school communications company. So if there is some sort of a snapback in the future from Alphabet and from Meta, I could see communications finally getting off of last place on the sector selector as an example. So just keep that, a pin in that thought for future reference. Let's go ahead and pop on over here to the main part of the platform now. And usually when we have a 1% up or down day, I try to kind of start our conversation off here with chart 6D, and this will give us this kind of slightly different visual as to helping us understand whether we've had a lot of extreme movements recently or not. First things first, be aware that the VIX was up nearly 15% here today. I know you can't really see that because it's a little bit distorted on the chart there, but this purple line down below will give you a general sense as to what the VIX is doing. And you can see that big V-shaped recovery that we saw in the VIX today. And remember, the VIX is typically inversely correlated with the S&P 500. So when the S&P 500 is down like it was today, the VIX is typically up and vice versa. So this was a pretty aggressive 15% move higher there in the VIX. You usually don't talk about it in percentage moves, so got to be careful there. But just know that we did bounce nicely in the VIX. Yesterday, we closed at around whatever it was, 17.5, and today we were back up to 20 on the VIX. So a pretty decent move there, which is telling us that a little bit of fear did enter the system here today. Now, this other graph here in the middle will give us a sense as to how often we've had these types of pullback days in the past. And remember, how to read this is there's a zero line that's in black here that goes in throughout the middle there. That basically is saying if the S&P 500 was up or down, nothing. It was exactly flat on the day. Of course, that doesn't happen very often. This next blue line that you see here, that's a little bit thicker in color. Technically, there's a yellow line in there as well that's a little thinner, but that's only a 0.5% move. So we typically focus a little bit more of our energy on talking about that blue line that comes next, because that will represent either a 1% up move or a 1% down move. If the bars are red and it's the lower blue band down there, then that means it was a 1% down day like we saw here today. So this was a pretty aggressive looking candle, right? This was one of the bigger sell-offs we've had so far in 2022. Obviously, it's early. But other than this one day right here, which was January 5th, today was the second worst day of the year. Now, stretching our horizon back a little bit further, obviously, we had a lot more choppiness in kind of late November, early December time period as well. In fact, I'd go as far as saying that this period from about the end of May to basically the middle of November was relatively quiet. Yes, you have a few of these bars popping out every so often, but they weren't all kind of clustered together. I think you can get away with saying that more recently, since basically the end of November, beginning of December, we have had more extreme movements. We've had a number of these bars just since basically this day, which was November 26th, just a little bit after Thanksgiving. We've had 1, 2, 3, 4, 5, 6, 7 days where we've been down at least 1%. That day itself, the 26th, it was actually down 2%, down to this orange line down here. And we've had a couple of other days that were very close to 2% pullbacks. But the point is, we've also had a lot of those green snapback days on the upside. So there's been a lot more choppiness here more recently compared to what perhaps we were lulled to sleep with throughout much of the summer, where we were just consistently grinding higher towards all-time highs for the most part. Is this as bad as what we experienced back in March and April of 2020 during the coronavirus era? Of course not. Back then, we were seeing these red bars going down 4, 5, 6, 7%. I mean, just horrible, horrible days. So we haven't seen anything like that recently, but it is a little bit of a wake-up call. I think people have started to become a little bit more nervous about the markets here recently. It's been an interesting market to say the least. We had a good conversation about this as well in my Q&A class today about how it's been difficult to look for opportunity within dividend growth investing, which is my focus as an investor, because a lot of your higher quality dividend growth stocks have continued to go up and up and up and up towards all-time highs, despite a lot of pullback in the tech-oriented areas. A lot of those growth stocks, the Cathie Wood types of stocks, which I think I saw on CNBC today. They said that Cathie Wood's flagship fund is already down 15% year to date, and we already know how terrible it was going into the end of the year. So she can't buy a break at this moment in time, and those stocks are getting smoked. Remember, going back to Tesla, that's one of her biggest holdings, and really how she made her name for herself and what has really fueled her empire for innovative and disruptive companies. And Tesla had hung in there like a champ a lot longer than a lot of her secondary players, but even Tesla is taking it on the chin now. So she's been going through some misery, I have no doubt. But those are the types of companies that are getting hit. In fact, I think I heard somebody say that in the NASDAQ, it might be the NASDAQ 100, but in one of those major NASDAQ-oriented indexes, that over 50% of the index was down at least 20%. In other words, basically in their own bear markets. That's a healthy amount. Half the stocks in that index were down into their own bear markets at this point. And you can't get away with saying that if you're looking at something like VIG, which is the Vanguard Dividend Appreciation ETF. At least I haven't checked that specifically, but I'd be shocked if that were the case, because knowing what I know about where the money has been transitioning recently, it's been moving towards those higher quality companies, moving away from the lower quality companies that are offering you promises a decade from now but have no real revenue today, right? So that's where the market was, in years past. They were willing to put up with with those promises of the future, of the bright future, and willing to, bid those types of assets up accordingly. We're no longer in that type of a market. We're in a market that's nervous. We're in a market that's seeking safety and is trying to look for those consumer staples companies like Coca-Cola just to hunker down in for a while. So it's been an interesting market to say the least. But remember that the S&P 500 is a market cap weighted index. And so, we've been kind of quietly wondering if they were ever going to start seeing their legs get chopped off, because these days, the biggest companies on the planet are technology companies. And while we've seen the second and third tier technology companies really getting chopped down late last year, we really didn't see that out of the mega caps like your Microsofts and your Nvidias and those types of companies. It does seem like we are seeing more of that here in real time, however. So we might have to pay our dues, so to speak. We've been blessed with very strong markets for a long time. Right now, it's been a little bit more difficult, and time to pay the piper, perhaps. Let's go ahead and get back on over here to our typical chart routine with 4B, where we can look at our foregrid. And you'll notice here that we now have bearish postures across the board. That happened quickly. And what I'm referencing is when I was with you last on Tuesday, we had bearish not bearish crosses, but bearish postures across the board. And yesterday, David would have done the video for you very late last night. I understand he had a big road trip with his team, so he got back late and did the video for you guys because he's a trooper. So well done there, David. But I didn't get a chance to listen to the video myself because I was busy teaching my classes today. But I'm sure he would have identified for you at that time that the posture did shift back to bullish on the S&P 500 as of yesterday's close. That was strongly bullish. The posture shifted back to weekly bullish on the NASDAQ composite and weekly bullish on the Russell 2000. Well, guess what? One day later, here we are with a market sell-off here today, and we are back to bearish postures across the board, exactly the way we were when I last left you just on Tuesday afternoon. So there's been some turbulence along the way in the last 48 hours, but we're just right back to where we started, basically. So anyway, big up days yesterday, followed by a big down day today to basically flush that bullishness back out of the system. So where do we stand now? Well, it's the same conversation that I've been having with you for the last couple of weeks in this presentation, which is I perceive these markets to be the upper two charts being our leaders, the bottom two charts being our laggards. And starting with the Dow Jones being our true leader at this moment in time, because it's the only one, as you can see, that is still above its rising 30-day moving average. With the S&P 500 slipping 1.42% today, notice not only did you give away your bullish posture from yesterday, but you also gave up that green 30-day moving average line that now has transitioned to yellow. What that means in this particular case is that the moving average itself is still rising, but price is now below it. So that's one way to kind of separate the wheat from the chaff. And so since the Dow Jones is the only one at this time that's trading above its rising 30-day moving average, you could qualify it as your leader. Now, it's not much of a leader, so we don't want to go overboard with that concept because obviously we have a weekly bearish posture on the Dow as well. But if you are trying to kind of look for leadership out there, you will likely find it a little easier within the Dow Jones Industrial Average than you will within these other three indices. And again, that goes back to that conversation I've already had with you, which is this is a market trying to seek safety in stocks like Coca-Cola, right? Boring companies in most markets, but right now a place where participants are looking for that safety. You will notice here that the S&P 500 was down 1.4% today, whereas the Dow was only down approximately 0.5%. So on a relative basis, the Dow did outperform all of these charts today and has been doing so on an intermediate basis as well. You can see that the intermediate reading on the Dow is 74 right now. It is falling, so that's why that's considered weekly bearish. It would need to be above 80 if it were falling to stay bullish, and that's not the case right now. So we're a little bit below 80. But it's not that far away at the same time, right? If we caught some sort of a bounce in the market in coming weeks, the Dow would likely be the one that could shift back into that upper reversal zone the quickest, because it's still closest to it right now, whereas the S&P 500's intermediate line is hovering right around 60 right now. The bottom two are even worse, right? And the NASDAQ composite was the worst performer here today, down 2.5%. Look at that candle there. It's pretty ugly. Not quite as bad as what we saw on the 5th, but still one of the worst days we've seen in several weeks at this point. And as I mentioned before, it reverted that posture back to strongly bearish. You can see that the moving average has stayed red this entire time. So despite a rather impressive move here, kind of like I mentioned to you on Tuesday, I wouldn't read too much into that until proven otherwise. What I'm referencing is the fact that we broke to new lows. We had a lower high. So lower highs, lower lows. Yes, we had a reversion to the mean rally, but we were still below that falling 30-day moving average. Today, we're seeing that it's kind of being used as resistance, being pushed back down and away from it. So not a good look there for the NASDAQ composite. There could be more pain on the horizon for a lot of those growth-oriented areas. Obviously that can change, and that's why we look at these charts as often as we do, because we want to spot the change as quickly as we can. But until it can get above that moving average and stay there for a while, my mindset is that the path of least resistance on the NASDAQ right now is to the downside. You can see here that the Russell 2000 is kind of suffering from the same thing. However, there's a noticeable distinction here with the Russell 2000, and you guys have noticed that change of my tone when it comes to the NASDAQ versus the Russell 2000 in the last couple of weeks as well, because a few weeks ago I would have said that the Russell 2000 was our laggard and that the NASDAQ was second to last. But my mindset has switched in the last couple of weeks, and one thing that is catching my eye right now to kind of support keeping my mindset that way at this moment in time is notice that the moving average on the Russell 2000 is now yellow. Now we can clearly see price is below the moving average. So what that means in this particular case is that the moving average started to rise today. Isn't that interesting? And the reason for that is because, the moving average is a lagging indicator, right? Pretty much all technical indicators are, but in the case of a 30-day moving average, it's lagging, where it's basically lopping off the 31st day way back and then adding the newest day and doing that repeatedly as time goes on. And so this pretty impressive move that the Russell 2000 had here off of its lows on December 20th up to these highs here on January 4th, that move is embedded within the last 30 trading days, and that is what is kind of helping that moving average itself go higher on a day when the price itself has gone a little bit lower. So you might be lopping off some of these really ugly days out of here. Those are getting taken out of the moving average. The more recent days are being added to it, and the more recent days, although down, are an improvement from the really ugly sessions that we saw back here about a month or so ago. So anyway, I found that to be interesting, and I think it kind of helps us stick with that mindset that as of this moment in time, the NASDAQ is the laggard. Russell 2000 doesn't look anywhere near as good as the Dow Jones, but it is looking a little bit better than the NASDAQ composite at this moment in time. But I will say the same thing for it. Until proven otherwise, I have to make the assumption that it is bearish, and if it can stay above that moving average for a longer period of time, which I think it has a chance to do, I'm willing to change my mind. But right now, you kind of have to just kind of go with the trend. Right now, we're still below that moving average. But I do like the fact that we have kind of these equal bottoms here. on the Russell 2000. So if we caught some sort of a bounce in the coming days or weeks and we were able to kind of hold these levels that matched back here at the beginning of December and then also at the end of December, I think that will go pretty well for the possibility of a reversal if that's what's to be in the cards. Now, if this breaks down below this low, then all bets are off. Then the assumption is we continue to go lower. But the point is, I'm holding out a little bit more hope at this moment in time that the Russell 2000 can go back to some perceived bullishness before the NASDAQ composite. Today was a really ugly day there for the NASDAQ, and there's still some really stretched valuations there from all of those service, cloud service companies, that type of thing, software companies, rich valuations out there. So some of that needs to be rectified, and the market sell-off day is helping us do that. So anyway, an ugly day for the markets, but it's kind of the same old what we've been seeing in recent weeks. NASDAQ's the worst. Dow Jones is the best. There's not a lot of great bullish charts out there, but where you're typically going to find them is in the big blue chip areas like your Coca-Colas of the world. Let's take a look at our 3 green arrows status now, and that will be chart 3. Actually, it's 4D. Here we go. 4D is our 3 green arrows chart. And as it stands right now, we actually have 3 red arrows on 3 of our charts, and those are the S&P 500, NASDAQ Composite, and Russell 2000. The only chart that does not have 3 red arrows is the Dow Jones Industrial Average. Notice that it has retained its green arrow from going above the 30-day moving average back here on the 22nd of December. And so we have a mix of green and red arrows there. We do have red arrows on the stochastic and the MACD, however, so be aware that it's not all great there either, but at least a little bit more resilient out of the Dow Jones. And another reason for me to say that if you're looking for a leadership index right now, to me it appears to be the Dow Jones Industrial Average. Not a great look for the markets in general when that is the case, because it tells us that the market is not particularly interested in taking risk. All right, let's go ahead and step away to the internet here briefly. I always like to get a chance to say thank you to those of you that help support these presentations. As you know, I try to shoot for triple-digit likes on Twitter for those of you that want to help support this free video that David and I offer you here on YouTube. And so the last time I did the video here on Tuesday, 104 of you stepped up to click like for me. So thank you to all of you who do that. Let's see who was in the mix here today. Let's start from the bottom there. There's Harry and Braun and Curdy and Keola, David and Sherry and Vishal and Brandon and Maria, Pam and Claire and Rich and Dean and Jeanette and Carlisle and Shireen and Stock Market Junkie. There's Laurelyn and New Low Observer. We've got Frank and BZ Japan and Jerry. We got tons of you, which we appreciate. I can't go through all the names because take too long to rattle off 104 of you, but you guys make me happy. Thank you for doing that. Remember, that is your best way to say thank you to David and I, is to click like for us there on Twitter. And there's 4 different ways to do it. You can either find it here directly pinned to the top of our timeline on Twitter if you're on Twitter actively. Otherwise, you can find it underneath where you're watching it on our website at marketscholars.com. We have this little Twitter widget, and you would just click the heart button down there. And then you can also find the link to the tweet itself in the description area of the YouTube video if you're watching it on YouTube right now. And you'll also find a Twitter icon that you can click on from the notification email that we send all of you as well. So however of those 4 you choose as your pathway, they all end up in the same place, and we really appreciate you guys helping us along with that. Also, while we're over here, just a friendly reminder that David will be teaching his technical analysis class tomorrow at 1 p.m. Eastern Time. Remember, that will be our final premium class until Tuesday morning, with Monday being Martin Luther King Jr. Day. The stock market is not open, so I won't teach my traditional classes there on Monday, but I'll be back with you with dividend growth investing first thing Tuesday morning at 11 a.m. Eastern Time. So make sure you're checking out David's technical analysis class tomorrow. I taught my question and answer session here for my premium members earlier today. If you are a premium member, feel free to check out the recording that's now posted on our website. Some of the content we discussed today was looking at a title insurance company as a dividend growth investing candidate, First American. We also had a conversation about maybe some discrepancies from the CCC spreadsheet that you can find over at Wide Moat Research versus Value Line in terms of their future dividend growth rates and what might be causing some of those differences between different financial organizations. We kind of dug into the details of how those numbers were generated on the CCC spreadsheet. Also had a question about selling a put on UPS. Also had a question on how do we distinguish between bull call spreads and bull put spreads. So actually used my example of TLT that I did for you guys in this video 1 week ago as a bull put spread to kind of use as an example of how I explain why I would choose a bull put spread versus a bull call spread in various scenarios. And then we also had a review of the Lucky 13 dividend list and if it matched up with our blue dividend stair-step charts at Market Scholar. So if you're interested in that content, make sure you're checking out the recording that's available to all of you who are premium members of Market Scholars on our Trading Rooms calendar. All right, let's get back on track now with some more chart analysis over on Thinkorswim. And let's do some, I wanted to show you one thing real quick before we get back into this. Over here on the internet, I wanted to show you the factor selector. We went through this yesterday already in class for my factor-based swing trading class. There wasn't a lot to report because as you can see, week over week, there was exactly 0 rotations from a factor perspective. It's kind of rare when that happens. It's not entirely unheard of, but it is fairly rare when there's 0 changes. But that was the case week over week. Basically, what we saw over the past week was that value held the top spot with dividend yield coming in directly below that. On the downside, we saw momentum stay dead last and low size second to last. Now, it was a little bit more peculiar when I was giving the presentation yesterday because we just got done seeing a really big up day in the market on both Monday and Tuesday. So I was a little bit surprised to see that momentum couldn't get off the bottom rung, but after today, I realized that made a lot of sense. Not that it was predicting that or anything, but if you were to kind of come over here and look at our chart 3D, this is the factor 6 grid here, you'll notice that momentum got absolutely smashed today. So momentum was down over 2% today. So from a factor perspective, by far and away the worst. Second worst was quality, which was down 1.2% because there's a pretty healthy amount of stocks within technology like Apple and Microsoft that would be considered quality these days. But you did see actual strength in value and dividend yield, right? Value was actually up today. It was up 0.16%, not a lot, but actually hit a new 1-month high, and the same thing can be said for dividend yield. It hit a new 1-month high and was up 0.05% today. So, what we saw there a second ago, which was based off of Tuesday afternoon's closing information on the sector selector, a couple of days later, I now see why those rankings all held true. While we didn't know it at this time with momentum going up 2 days in a row here, actually 3 days in a row, there was a huge hammer to be dropped on its head here today. Not the hammer candle pattern, but just something heavy that dropped on top of this as it touched that 30-day moving average right there, and boom, right back down, an ugly move there in momentum. And so now it makes complete sense to me why the factor selector tool was suggesting that momentum needed to stay in the penalty box a bit longer, whereas we do continue to see strength there in value, and we continue to see strength in dividend yield. So I found that to be rather interesting today as well. Let's do some 12 grid analysis now. I'm going to take a look here starting at our asset class 12 grid, which will be chart 5A. And a reminder that when we're looking at these 12 grid charts here like this, that the background color will typically tell you whether the intermediate posture according to the market forecast is bullish or bearish. If the background colors are green, it means that they're bullish. If the background colors are pink, that means that the posture is bearish. And so let's go ahead and get started. Let's get started with a bright spot, at least for this presentation's purposes, which is bonds actually rallied today. Take a look at TLT. It was up nearly 1%. That's actually a pretty good day for TLT here today. The reason I say it's good is because of that trade that I did with you guys exactly 1 week ago, where I sold a bull put spread immediately after these two back-to-back oversold cluster signals here. So we are making money on our bull put spread on this trade that looked like it was destined for failure for those of you that were just merely looking at the trend. Remember, my mindset around that one was not that this is necessarily a time to buy TLT, because I, for one, think that TLT will go down over the long term. But I did think that the selling pressure that led up to those oversold cluster signals was too extreme and was unlikely to be repeated in the next 30 days of the options expiration cycle. Now, who knows if that's going to happen or not? So far, so good, but as I mentioned on Tuesday, it's too early to run a victory lap here. But what I am happy to report is the fact that it went up today. And I didn't check what was going on with bond prices first thing in the morning. I actually start teaching my question and answer session 30 minutes after the stock market opens. And so I, in order to prepare the presentation and get everything opened up and everything like that, I don't have a lot of time to spend on absorbing everything that's happening in the market before I get into that particular class. That Q&A class is held an hour earlier than my normal trading rooms throughout the earlier part of the week. So Thursdays are a day where I don't get a chance to absorb as much information prior to getting into class with all of you premium members. So I didn't know what was happening with bond prices when we went into the question and answer session, and those of you that were there with me know that I was a little bit surprised, because what I did know was that the NASDAQ was getting hammered today. So my general assumption right out of the gate was, knowing that the NASDAQ was down, I figured bond prices were getting annihilated, right? Because that had been the correlation prior to this past week. Usually we had seen a situation where bond prices were getting annihilated, Treasury yields were going up dramatically, and that was part of the reason that the growth-oriented tech stocks were getting hammered. So I was pleasantly surprised today when I got out of class, when I realized that TLT is actually rising on a day when the NASDAQ was getting hammered. And remember, that had not been the case here more recently. So that just kind of emboldens me a little bit more on that trade idea that, yeah, that was too much selling. The market kind of overdid it on the downside. And while TLT probably is not going to go into some, immense uptrend from here, there's a better chance now, I would say, than where I was a week ago, that TLT can stay above 139, which is what I need it to do for that bull put spread to be successful in the month of February there. So happy to see that for that trade's purposes. Now remember, when bond prices are up, all else being equal, what you should assume is that Treasury yields are down. In this case, TNX was down here today. We ended at 1.71% on the 10-year. Can actually see that was its third day in a row of selling. Now, obviously, we are still in an immense uptrend on rates right now, but there's this massive air pocket between where we're trading right now versus where the moving average of rates typically is. And so there is potential for further give back in interest rates in the future, despite what you're hearing with the Fed, right? We heard with Brainerd here today when, she kind of startled the markets and saying they want to get inflation under control and, wouldn't be surprised to start raising interest rates and this, that, and the other thing. So we're hearing a lot more buzz about that type of a conversation these days. But the reality is it might have already been priced into a degree with how rates were surging right out of the gate as we started this year, and they might have overdone it to a degree to the upside. So we still have the strongly bullish posture on TNX. And I would also say that a secondary thing that I'm keeping my eye on here is whether it can kind of hold this level where we had this double top before, right? This was back on basically October 22nd. And then again here on November 24th. It would be interesting to see what happens with rates if we pull back just a little bit more to kind of brush the tops of those two candles to see if there's anybody that's going to step in at around that level. So let's all keep our eyes on that possibility. Now, another story that we've been watching here lately has been the US dollar, right? I talked about that quite a bit on Tuesday with that candle leading to multi-month lows, right? At the low of that candle for UUP, we actually went all the way back here to November 15th. Well, I got news for you. The last 2 days haven't been any more kind to the US dollar. In fact, we are in a bit of a free fall situation in the US dollar right now. Back-to-back sell-off days. Now, to the credit of those that are trying to remain bullish within the dollar right now, they were able to nearly get it back to break even today. Yesterday was a really terrible day, a gap down day, and not only a gap down day, but a continued sell-off after the gap down to close near the lows of the session. So yesterday was an absolutely horrendous day for the US dollar. Today, there was a little bit more resilience under the surface, although we did still close lower just barely there. However, you'll notice things have gotten so bad with the US dollar, we're now talking about oversold cluster signals with it. So it is possible things got a little bit overdone there. Maybe we'll start slowing down that descent on the US dollar as well. The bad news on that front is it's a lot harder to trade credit spreads on the US dollar, similar to the concept that I taught you guys last week on TLT. TLT is a lot more liquid in the options world than UUP is. So there you're going to have to find other ways to try to take advantage of that if you think that there is going to be a slowing down of the dollar there. Remember, the dollar does tend to impact commodities prices. And while the dollar closed just a little bit lower, UUP was down one whopping penny when it was all said and done today. Remember that the opposite can also be true for commodities. And oil is kind of a good example of that here today. Oil closed down by 1% today. That's a pretty ugly day. You can see it was actually a bearish engulfing candle there on USO. And so we did close near the lows of the session on USO at the time when the US dollar closed near the highs of the session. The gold didn't really kind of hold those typical relationships. Gold actually ended up closing near the highs of its day as well. So it was down today like oil was, but it wasn't nearly as bad as it was earlier in the session. Gold has held up a little bit better here recently. And, we've been talking about it here during this last couple of month period where I've been talking about the idea that GLD could have been an interesting iron condor candidate. And I still believe that to be the case. We really have not broken out in a big way. We've stabilized. We've become slightly more bullish on gold. But this is not a trending chart. This is a chart that is chopped sideways. And so for those of you that have been selling iron condors on GLD for the last couple of months, well done. You likely have been successful in that endeavor. You will notice that with oil's sell-off today, not a big surprise that high-yield bonds also sold off today pretty violently. Now keep in mind context here, we're talking bonds, but this was a 0.36% pullback. You can see by the size of the candle, that's a fairly big day for it. Not the biggest day, but definitely an above average type of a sell-off day for high yield bonds here today as well. Bitcoin, as I mentioned on Tuesday, I was a little bit disappointed. Now remember, I didn't know what was in store on Tuesday for the markets here the last couple of days. I didn't know the markets were going to get hammered here today. But what I did tell you on Tuesday was I perceived the move in Bitcoin to be highly disappointing. It was only up like 1 or 2% that day when the rest of the market was up significantly. And I said that's a rather, I think I referred to it as a whimper because I would have expected Bitcoin to be up like 7 to 10% based upon what I was seeing with other risk-on assets, and that wasn't happening. And I said that could be a potential problem. And here we are just a couple days later, and we are back to the downside again, right? Down a couple of percent there on Bitcoin. Now, it didn't give up as much today as you normally would have on a big sell-off day, but I think that's because it didn't go up very much the other day when the market was up a lot. So kind of offsetting from that perspective. But the intermediate trend remains strongly bearish. Perhaps that can change because we've got a lot of these oversold cluster signals, but as I was telling you a couple weeks ago, that's kind of like the boy who cried wolf there. At some point, you stop believing those oversold cluster signals, right? This is a distinctly risk-on asset class here, and this has been a market that has been shying away from risk. On the top side, you can see that we did have a bit more of a sell-off today in EEM. It was down 1.42%. That's a little different than what we saw on Tuesday. Remember, Tuesday was this candle, a big up day for EEM. That was a day when a lot of those Chinese internet companies were up a bunch. we actually gapped up even higher yesterday, but then gave back most of yesterday's move with today. And now we're kind of back to where we ended there on Tuesday's close. But we do remain with a strongly bullish posture. And part of that could be because the dollar has been rolling over. All else being equal, that tends to favor foreign assets. And so with the dollar closing near the high of today's range, basically at the high of the candle. So again, down 1 cent, but basically recovering all of its intraday losses other than that 1 cent. We shouldn't be surprised that EEM basically closed near its lows and actually ended up underperforming the S&P 500 just barely. EFA did manage to outperform the S&P 500, but still had a pretty ugly looking candle in its own right, bearish engulfing candle there on EFA. But both EFA and EEM continue to have strongly bullish intermediate postures. In fact, I was looking at this ratio chart, which we use 5Q here for those of you that are premium members. And I was noting how there's been a decided change in the sentiment of U.S. stocks versus foreign stocks. Last year, it was no question. The U.S. was the place to be. This year, there is a question, right? We've topped out. We topped out basically on December 30th, and this chart has rolled over. That rolling over in this particular case means this second security is outperforming this first security. So foreign stocks are outperforming U.S. stocks since basically the end of last year. So I don't hear a lot of people talking about that. Part of it driven by that weakness in the dollar that I showed you a moment ago. But keep your eyes on that possibility because foreign stocks have been out of favor for years and years and years and years. And if there's any value left in the market, some of it might very well be overseas. A lot of the U.S. assets are still very overvalued at this point. Also, you'll notice some of your traditional growth versus value relationships really kind of one-sided these days. This green chart in the lower left-hand corner is telling you how much value is outperforming growth right now. And then you can also use consumer discretionary versus consumer staples to figure that out. And notice that this is a sliding lower chart as well, basically telling us that staples are outperforming discretionary, which is not a great look for the market if you want to be kind of in a bullish risk-on mindset. From a sector's perspective, I kind of hinted at this already when we looked at the heat map, but be aware that there were only 3 sectors that finished higher here today. Industrials were up 0.22% today, staples were up 0.18% today, and utilities led, they were up 0.49% here today. Remember, interest rates were falling here today as bond prices were rising. That can positively impact utilities. It didn't help real estate, but that's kind of a different conversation these days. As I was mentioning to my premium members here in class last week or the week before, I'm actually a little bit more concerned about real estate than utilities, mostly because they're a victim of their own success. If you look at the lows of real estate from the coronavirus era and then compare it to the lows with utilities, you'll see that the real estate sector came firing back to all-time highs, whereas utilities never did. And so if there is some sort of a pullback to come in those interest rate sensitive areas, I'd actually be a little bit more nervous about real estate if that is what is to unfold from here. We'll see. But take a look at utilities bouncing higher right there at their rising 30-day moving average. Bad news is all of my semi-excitement about healthcare on Tuesday has been flushed right back down the drain. We have to be careful on that. Sometimes I look at healthcare with rose-colored glasses because I happen to like healthcare as a sector for the long term. But I was hoping that healthcare would catch a bounce. On Tuesday, we were right there above that rising moving average. Here we are just 2 days later, giving up pretty much all of that move. Whereas we've seen more resiliency here in utilities, we've also seen some resiliency here in consumer staples, which remain with that strongly bullish background color as well. So today's losing sectors were technology, no surprise given what we've saw there with the NASDAQ composite. Look at that ugly candle on tech. A lot of that as a result of Microsoft selling off by 2.6% here today. And all of a sudden, we're very close to like 2-month lows, right? Very close. And we're below a falling moving average there with a strongly bearish posture. I would also point out discretionary looks pretty pathetic here as well, but we do have to keep in mind context here. Remember that Tesla and Amazon and Home Depot are the big three within discretionary, and with Tesla falling by about 7% or whatever it was today, no surprise that discretionary in general was down by 2%. So that's kind of an ugly looking chart there as well. Maybe not quite as bad as what we saw in technology, but kind of there in that same general vicinity where we're falling below, or we're below a falling 30-day moving average, strongly bearish background color as well. So anyway, this was a day that would be considered risk off, with 2 out of the 3 sectors that were up being our defensive areas of staples and utilities. All right, let's get into their trade application example here today. And when we have big sell-off days like this, I generally go hunting for sold put opportunities. Those of you that know my style from my premium classes should not be surprised to hear that. So I want to take advantage of rising volatility and look for stocks that have longer histories of raising dividends to sell puts upon if there are attractive enough levels. Now, I do have some problems with that these days, and that goes back to what I stated earlier in the session, which is the market has fallen in love with the types of companies that I love, which are the dividend growth stocks. So it's hard to find those types of companies that have been absolutely massacred out there that have longer histories of raising dividends. So I can't bring you kind of your traditional blue chips here today, like your Coca-Colas and Procter & Gamble's. Those stocks have not been hammered, and so they don't make it a good fit for what I'm hoping to accomplish when I'm selling puts. Remember, when I'm selling puts, effectively what I'm doing is I'm finding companies that I wouldn't mind owning at a lower price. And in doing so, I get paid a credit up front for my willingness to sell a put, but in return, I assume the risk of whoever bought that put for me or from me, and they then have the luxury of being able to offload their merchandise at the strike price that we transacted at. So I bring to your attention PetMed Express. This is ticker symbol PETS, P-E-T-S, not to be confused with P-E-T-Z, which I believe is a penny stock that I see scrolling across CNBC on occasion. So this is P-E-T-S, but be aware I would consider this a very speculative sold put trade nonetheless. This is only a $500 million company. In other words, a very small cap company compared to the mega caps I traditionally try to bring to your attention. But it did catch my eye for this reason. You can see here it was trading in this white zone of the dividend stair-step chart that we used for my dividend classes for much of last year. As we crossed into the calendar year 2022, notice that we have now started to trade into that blue zone itself. What that is signifying in this case is that its current yield at 4.91% is in excess of its average high yield throughout history of 4.7%. Remember, that number is different for every single dividend stock out there. So it makes this think script here highly unique and proprietary to us at Market Scholars. And as I was mentioning in my class this week, it is my job now in the next couple of months to run through the calculations of about 700 companies and then refeed that script. And once that's done, I'll let those of you that are my premium members know that those are updated, but it's basically a rolling 10-year process. So every time we cross a new year end, like we have just recently, I need to lop off the 10th year way back and then add the most recent year. So I'll be doing that in the next couple of months, which means that these blue lines will be adjusted at that time. But for right now, we'll still use last year's numbers, and it probably won't be all that different in the end. And you can see here, this would now be deemed as somewhat attractive. Now, obviously, this is a higher risk situation because PetMed Express sells pet medication online. And obviously, they don't have the world's greatest moat when you're doing something like that because you're probably competing with a lot of other companies that can do nearly the exact same thing. But what PetMed Express does have in its favor is a longer history of raising the dividend and a currently attractive above average dividend yield to boot. So what I ended up doing was selling the $20 strike in the month of February. that gives me about 18 to 20% of flexibility between where it's trading now versus where I'm on the hook for purchasing this stock in this paper trade here that I already did in today's session. Remember, I always do these trades while the market is open and then send them out to all of our premium members via our Telegram Trade Alerts app. So that way all of you premium members can get this information before everybody else that's just watching the free video at night. So make sure you're paying attention to that. But one of the reasons I like the $20 level, first of all, I could get paid more than 1% return on risk, which is important. But in addition to that, I also happened to catch that there was this gap, this air pocket that took place back here in October of 2019. You had this big gap up. And sometimes what you'll find in technical analysis is that participants within the market will try to protect those gaps. When they get breached, then you can assume that the gap will fill. In this case, that gap starts right down here at about 20 bucks. So there are some people that will be holding off on wanting to buy this stock until it gets to 20, but then at 20 they might figure that the selling has become a little bit overdone and they're willing to dip their toe in the water again. And if they're willing to do that, they can help support the price at 20 bucks, which would be favorable for our trade that we have here where we're selling the $20 strike price there for the month of February. Now keep in mind, you've got to trade through this earnings announcement that's coming up a week from today. So again, I need to stress that when we are selling naked puts like we're doing here, you have to be willing to own this company for the long term, especially in a situation where you're trading through an earnings announcement. So for many of you, this will not be a good trade for you and your personality unless you have a really high opinion of this really small cap company, which probably doesn't fit the profile of a whole lot of you. So some of you might choose to wait until earnings have already been announced a week from right now to consider taking the trade at that time. But because I needed an example for tonight's video, I opted to go that direction. We'll roll the dice on this one. Notice it does have an oversold cluster signal using weekly candles. That's what those little green dots underneath the price bars are telling us, that there is a oversold market forecast cluster using weekly candles. And so that could help give us the impression that this one is trying to carve out some sort of a low in this general vicinity here as well. Okay, so that's what I had for you here today. If you enjoyed the presentation, as always, I ask one simple thing out of you, which is help support this on social media, in particular Twitter. As long as we're getting up and over 100 likes on Twitter, I'm happy to continue to do the videos. If we're below that metric, then I'm less enthusiastic about it and might end up doing, kind of a more moderate 15-minute video where it does not include a trade application example like we have here tonight. So do your best to help support us there. We do appreciate all of you that help us along with that. Since I won't see you guys tomorrow, have a great weekend as well. Enjoy your holiday weekend with an extra break, an extra one-day break there from the market on Monday. And then I hope to see everybody as we get rolling again next Tuesday. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.